Hello, my name's Vicky Boucher, and I want to call this Don't Be Greedy. And I was watching the news last night, and I want to draw what I think is a really interesting parallel between the challenges that Thames Water are now facing and the crisis of maybe we're going to end up renationalising, a water company in the UK, and the concept of building a profitable property business. So let me just summarize Thames Water for you, and I'm just going to summarize the very, headlines of it. So Thames Water are one of the largest suppliers of water in the UK. When they were created, can't remember how many years ago, they were sold off by the government into the public sector, or change that. Sorry. I'll start that piece again. I'll start the whole thing again. I want to call this episode Don't Be Greedy, and I want to draw what I think is a very interesting parallel between Thames Water and the crisis that we're seeing playing out in the British news at the moment, and the concept of building a profitable property business. So let me explain a summary of the Thames Water situation. So Thames Water is a regular company out there on the stock exchange, etc., and one of the largest suppliers of water in the UK. When they were created as this company, rather than being held nationalized by the government, they were sold off with zero debt. So a very good investment for people to buy into. Fine, off they went. Here we are now in 2023, and they have in excess of, if these are the numbers that correct that I listened to on the news last night, 50 billion of debt. I'm sure it couldn't have been billion. Maybe it must be million, but a lot of debt, right? They've got a poor record of generally water leaking. And I understand that if you're here in the Thames Valley area, it's historically very Victorian system going on. So there's all this old pipes. But I mean, why haven't we got a program of replacing them all? All right, that's a whole nother story. Then they've got a history of sewage leakage. So sewage actually leaking out into the main water system. So our freshwater rivers and the Thames and things like that. And obviously spilling out into people's gardens and streets. I mean, we've got one here in the village where there's a leak appeared and it's sewage pouring out into the street again. But that is laid against, so massive debt, problems with the network, problems with repairs and everything else. But they've paid out 70 billion in shareholder dividends. So this is one of the problems with a company with dividends, in that you want people to buy shares in your company because that keeps your share value up. Keeps you popular on the stock market, the trading of shares, and hopefully keeps your price increasing so that people will want to buy it. And there's all this trading going on. What you don't want is your price to fall, everybody sell your shares, and then there's a problem, right? So you need to keep up your reputation, if you like, out there on the stock exchange. One of the ways you can do that is you can bribe your shareholders, and I'm using that as quite a strong word, bribe your shareholders by giving them, and let's call them annual dividends, by giving them a bonus every year. So you've bought a share, you've given me your money, but in return, I'm going to pay you this thing called a dividend, which is really a share of the profits of the business. The bigger the dividend, presumably the bigger the profit that I'm making. But how can you be paying out a big dividend, which implies big profits, when you've got big debt, which implies big losses? So it's a really interesting how we use the language. Why is that relevant? Because everybody now is being encouraged to buy their property through a limited company. One of the ways that you can take money out of a limited company is through a dividend. And in the UK, it would be something like a 7.5% tax cost. And that's cheaper than if you took the money out as regular, like wages style income, where you'd be paying either, say, 20% or 45%. So As a property investor using a limited company structure, you are like a very, very microscopic little Thames water, in that you are going to invest in something. You will have a responsibility to maintain it and run it. And when you make a profit, you can take that money out as a dividend. And what might happen, because this is you and your money, is you might be tempted to take out more money and not necessarily do the repairs. So I come across landlords all the time looking to sell their properties, and every property that I come across has got a catalogue of repairs. Now, you could argue that if you're going to sell a property, why would you be doing the repairs maybe in the last 3 to 6 months when you're deciding to sell it? Because you want to maximize the profit. And I completely understand that, okay? So you're going to put the house on the market, some minor repairs come up. Obviously, you deal with anything that was an emergency, you have to. But anything else you might let slide, fine. But these aren't repairs that have just occurred in the last 3 to 6 months. These are repairs that have occurred in the last year or more. Now, is that because that landlord is struggling financially? They don't have enough money. Maybe they're not always in limited companies. These are probably, when I call older landlords, I don't mean their age, but they have been investing for longer. So probably held in private names. They've probably been using the money themselves. They've probably not been thinking like a business owner. And so they've been using the cash flow as they get it, probably to subsidize their lifestyle, or maybe even subsidize the rest of their portfolio. And they've not been paying attention to their properties. Okay. So this systemic lack of investment in their asset is going to make me want to offer less for the asset, because obviously I've got to do repairs. So I can give you an example at the moment where there is a landlord, a vendor looking to sell a property at 120,000. Quite frankly, it's actually a really good price and a great return, even if I paid that. But I know that there are a lot of just fiddly things. It's not like, I don't know, it's not like there's something major like the roof's gone. Okay, these are just lots of bits. We probably need to replace the kitchen. While we're doing it, we're going to need to redecorate, recarpet. We may as well do the kitchen while we're at it. We may as well do the bathroom, because all of those are tired of not being taken care of. We'll need to look at this. There's window problems. There's guttering problems. There's problems where they've not maintained the garden and the fences and everything else. And all of these little bits and pieces are going to add up. And I'm not going to be prepared to offer more than 100,000 on it. So this landlord is going to lose £20,000. And bear in mind where we are in the market. It's a slowing market now, and it's going to probably stagnate. And therefore, I've got the option to invest. They have maybe, let's say, over the last 4 years, since just before COVID, probably taken their eye off the game, maybe been taking all of the money out, not done some repairs that they should have done. Because honestly, within 3 years, you probably would expect some work to be required in a property if the tenant doesn't move out. And there's obviously a catalogue of repairs there, because otherwise I wouldn't already be being told about them. And so if the landlord's been taking the profit rather than investing in the asset, then this is causing a problem. So let me just look at the maths of that problem for you. Now, the simple buy-to-let model is you buy an asset, you rent it, you collect the rent, you pay the letting agent their fee, and you pay the mortgage. And the rest of that is sort of your profit level at the moment, right? Now, that profit not only includes money that you can have, but should also include a reserve for repairs and refurbishment. Now, when I work with clients that I source for, I make sure that they have that budget up front. So I'm asking all of my clients to have £2,000 sitting in their now company account, so that if there are repairs there, that money is already taken account from. And then that way we can just look at the letting agent and the mortgage being deducted, and the rest of the money will then be profit. But if you're like Thames Water and you start to divert all of those profits into your landlord pocket, and there's no reserve, and there's no repairs, and there's no investment, you're going to start to see gradually an increase in tenant turnover, and at worse, an increase in voids. And again, since COVID, landlords have probably got a little complacent over the last 3 years because there's been such a demand for tenants that rents have been going up. And if you put a property on the market, there's always a queue of tenants going in. But what you're going to start to see if you start renting out lesser quality properties is you'll get lesser quality tenants, and you'll start bringing in tenants into your portfolio that are going to not take care of the property because they will view it that you haven't taken care of the property, and they'll start to be a spiral. Now let's look at if a tenant gives notice. Not only are you going to lose probably something like a month's rent, let's just look at that, but you're also going to be forced to do some refurbs, or you're going to be forced to rent it at a lower rate. So a tenant leaving could cost you the equivalent of 2 months' rent. The month while it's empty and you're finding a tenant and you're faffing about trying to do some repairs or get some tenants in. And then when that tenant moves out and you don't do the repairs and you have to put in a tenant for less rent, there's that consequence. Or you do the repairs and then you put in a new fair rent paying tenant. 2 months rent out of a year is going to take you a long while to recover. You just imagine that the rent is £500 to make the maths nice. You're now going to lose, no, let's make it 600 because that'll be even better. 600, and you lose 2 months, you're going to lose £1,200. To make that money back in a year, your rent is going to have to increase from where it is by £1,000. And if you haven't done a fair amount of repairs, and with 600 quid, it's not going to be a fair amount of repairs. It's going to be a lick and a split around the property. How are you ever going to make that money back? And so to provide a fair property at a fair rent that gives you a decent, reliable profit into your business, you're going to have to maintain that asset. Does that make sense? So if you don't take care of your asset, how can you charge the best possible rate? How can you get the best possible tenant? How can you achieve the best possible profit? It's a cycle. You've got to look after it in order for it to perform. And Thames Valley, if we just go back to them, have not been looking after things. They have been vanity paying out their shareholders through dividends. If you do that in your portfolio and you start drawing all the money out, you're going to find it'll have an effect. So, in summary, to run a successful property business, or any business for that matter, requires a business plan. And the business plan must be to equally generate an income and plan for the long-term investments and maintenance of the asset, of the machinery, of the staff, of the products, of the marketing, of all of the things that you have to do when you run a business. And this is something that not Thames Water, not the other utility companies, if you think about the councils, not even the roads, and of course for us as landlords, we're not paying enough attention to. Okay, so success is a balance of profit and not just dividend or interest. Okay, and I just wanted to share that with you because I watched that last night and it really struck a chord with me. And I thought, as more and more investors are investing in limited companies, you must think of this as a property business, not be tempted to just pull all of the money out. You need to invest in that asset. You've got to think that your tenants are your customers. Your house is basically the product, the service, the machinery of the business. The house is the thing that makes you the money. And if you don't take care of that, if you don't oil it, if you don't service it, then you're going to have big problems. And the big problems are going to appear as you get tenant turnover, as you get voids, as you get lower rents, and worse, as you get lower quality tenants. And that's the way things start to spiral. And then that has a knock-on effect throughout your portfolio, because then you start using other properties to support the one that is now a poor performing property, but not because of its own fault, but because of the way you've managed it. And then the next property will crumble, and the weight shifts down through the portfolio before it all crumbles. And that's how I start to see entire portfolios coming from landlords. End of nag. I hope some insight for you. I hope some really important lessons in that little video there. My name is Vicky Washea. Do follow along on the podcast. You can watch the whole podcast either on my YouTube channel by looking up Vicky Washea, or go to Apple and Spotify and look up the podcast by its name, A Wealthy Life. I hope that you sign up for more tips and trips like this. And if you've got any comments, I'd love to hear your feedback in the comments below. Thank you very much for listening, and I hope I've been able to put a little bit more whoosh into your property business.